Vaccines and the big fiscal stimulus package passed in the United States have the global economy on track for a strong rebound in the second half of the year. We expect the reopening trade to favour equities over bonds and the value factor within equity markets over the growth factor. We also think that share markets in the rest of the world should outperform the United States. Hi, my name is Andrew Pease and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to the second quarter update of our 2021 Global Market Outlook. After last year's false start, the prospects look good for a sustained reopening of the global economy through the second half of the year. The vaccination rollout plus prior COVID-19 infections means that 60 to 70% of the population in most developed economies should have some immunity by early in the third quarter. This, plus the large fiscal stimulus package in the United States, has shifted investors from worrying that growth will be too slow to now fearing that growth will be too fast and put more upward pressure on interest rates. We agree that economies are poised to rebound sharply as restrictions are lifted, but disagree that inflation pressures and interest rates are likely to increase by a lot over the next 12 months. It's going to take until at least the middle of 2022 for the US economy to recover the lost output from the lockdowns, and it will take longer in other economies. This means that broad-based inflation pressures are unlikely to emerge until 2023. It also means that market expectations for the US Fed to begin lifting interest rates in 2022 are premature. The Fed probably won't begin to tighten until late 2023 or early 2024. The vaccine rollout and the large fiscal stimulus have increased our conviction in the cycle component of our cycle, value and sentiment investment process. The fact that global equities are expensive and our sentiment indicator is close to overbought levels stops us from being too bullish. Our strong cycle view, however, gives us a preference for equities over bonds for the remainder of the year. It also reinforces our preference for the value factor within equity markets over the growth factor. The value factor has a large weight to financial and cyclical stocks that will benefit from the reopening of economies, while the growth factor is overweight the technology and healthcare stocks that did well during the lockdown. The recovery from lockdowns should also help non-US markets outperform the United States. The S&P 500 is overweight the tech and healthcare stocks that dominate the growth factor, while the rest of the world has more of the financial and cyclical stocks that make up the value factor. The next phase of value outperformance is likely to have greater leadership from non-US markets. Europe, for example, has had less yield curve steepening than the United States. This has held back the performance of its financial stocks relative to the United States. We expect that the lifting of lockdowns in the second half of the year will put upward pressure on European bond yields and give the value factor a further boost. Turning to risks. The good news on vaccinations and stimulus means the most significant risk is that long-term interest rates rise by more than we expect. This could provide a test for the US equity market, which is expensive in absolute terms and only appears attractive when compared to low treasury yields. Equity markets can usually navigate rising bond yields if the reason is better prospects for economic growth. It's a different story, however, if yields are rising on concerns that monetary policy will be tightened. A rise in the 10-year US Treasury yield towards 2.5% would provide a test for equity markets. We think, however, that market concerns that the Fed is about to turn hawkish are unwarranted and that the Treasury yield should remain below 2%. The Fed has made clear that it will leave rates low for an extended period to ensure that the economic recovery is sustained. The other major central banks are similarly dovish. Let's turn to our asset class preferences. We prefer non-US equities over the S&P 500. The post-vaccine economic recovery should favour cheap cyclical and value stocks over expensive technology and growth stocks. The rest of the world is overweight cyclical and value stocks and underweight technology stocks relative to the United States. We like emerging market equities. China's economy is on track for a strong rebound this year, and emerging markets more broadly will get a boost from stronger global demand and a weaker US dollar. High yield and investment grade credit are slightly expensive, but will benefit from the lockdown recovery. Government bonds are still expensive even after the recent sell-off. Low inflation and dovish central banks should, however, limit the rise in bond yields during the recovery. The US dollar has been supported this year by the big stimulus announcement and expectations for early Fed tightening. We think the dollar could weaken later in the year as investors unwind Fed tightening expectations. It should also weaken as the global economic recovery gets underway, since the dollar typically gains during global downturns and declines in the recovery phase. The main beneficiary is likely to be the euro, which is still undervalued. British sterling and the economically sensitive commodity currencies, the Australian dollar, New Zealand dollar and Canadian dollar, can still make further gains, although these currencies are no longer undervalued from a longer-term perspective. The big US stimulus and the vaccine rollout sets the scene for a strong global economic recovery in the second half of the year. This means that despite being expensive from a long-term perspective, equities should continue to do better than bonds. It also means that the rotation away from expensive, technology-heavy growth stocks and towards cheaper, cyclical value stocks should continue. Thanks for watching, stay safe, and we'll talk to you again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.